Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get straight to the headlines this afternoon. Equity indices weaken in afternoon trade as investors take a closer look at earnings. The GST rate cuts fail to cheer broader markets.
Bond yields head higher with the 10-year yield moving towards 7%. Investors worry about fiscal slippage and tightening liquidity.
Idea Cellular announces the sale of its tower arm to American tower company for 4,000 crore. The company also reports separately a wider loss for the second quarter.
Tepid listing for New India Assurance, the country's largest general insurer, debuts at a discount on the markets.
Those are the top stories. Also on the show, bringing you some voices. L&T Shankar Raman explains what happened this quarter and why they had to cut their order inflow guidance. That's a conversation we'll bring you a snippet of, and we'll try and understand what the mood in the bond markets looks like. Lakshmi Iyer of Kotak Mutual Fund will be joining us on the show.
But first, let's talk about the markets. Well, GST cheer hasn't quite turned out that way. Neeraj is taking a look at some of the stocks in the markets today. It's a bit confusing whether the cut in these items has really worked, not worked. You're seeing some profit booking today.
Yeah, so I would reckon the bond market reaction is probably having a bit of a rub-off effect on the equity markets as well, because if the bond markets would be worried, there is no way the equity markets wouldn't be worried. So earnings, frankly, have probably nothing to do with what the index is doing today. You brought up the topic of the GST reaction. Yes, it's been a bit mixed, but that's not the overpowering theme, frankly, in the markets today. Somehow, in today's session, while there has been a return to safety of sorts with technology doing really well and select banks on which earnings like SBI, etc., which have been doing okay, is doing well, but there is an uptick in volatility. So India VIX is up, and if you look at the list of losers, oil and gas, both upstream and downstream, have corrected quite strongly. So the likes of ONGC, BPCL and a few others have gone down. Larsen and Toubro has actually recovered a bit of its lost ground, but still down in trade today. And multiple headwinds for companies like HDFC, which have been correcting now for a series of days, and in today's session too has come off. Yes, there are select pockets which might be doing well based on earnings or otherwise, so or bulk deals. So mid caps have a different story to chart, but frankly, in terms of the large caps today, you would probably attribute the nervousness more to macro concerns, if at all, and just the resultant and just the continuing market mood, as opposed to anything that's happened on the GST front. Speaking of, just before I wrap up, just one quick thing on the GST bid. The reaction is not in line with what the actual impact could have been. So you're seeing relief for Titan. The management was pretty optimistic about what this would do, but the stock is down. GSK Consumer was hailed as one of the best FMCG winners as a result of the GST rate cut. That stock is down. HUL is marginally higher. So the GST rate cut is really not having the desired impact on the stock prices, if you will.
Surprising, Neeraj, but thanks so much for giving us the structure of the market. That is the way the market doesn't always react on predictable lines. We'll move on to news coming in from the corporate side. Idea Cellular and Vodafone India have decided to sell their individual tower businesses to American tower company for $1.2 billion. The agreement is expected to be completed in the first half of 2018. Joining us for the structure of the deal, but also perspective on the deal, we've got Sumit Sarkar of Bloomberg Quint and Bhuma Srivastava of Bloomberg News is with us as well. Sumit, I'm going to toss it over to you first. Can you just run us through the details, the fine print of the deal?
ATC will be paying around 7,850 crore for these tower assets, and Idea will be getting around 4,000 crore rupees, while Vodafone will be getting around 3,850 crore rupees. Now, Idea has around 10,000 towers and a tenancy ratio of 1.8 times, while Vodafone has close to 10,235 towers with a tenancy ratio of 1.52 times. Now, what will and the proceeds of this issue will be used to repay the debt of the merged entity. So, what will ATC get from these tower assets? These tower assets will add around 6 to 8% of the market share to ATC. ATC currently has around 13% market share in the tower industry, and another 6 to 8% will be added by these tower assets. Along with this, on an annual basis, the revenue, these tower assets will add around a revenue of around 2,100 crore rupees, with a gross margin of around 800 crore rupees, while other expenses, which include selling, general and administrative expenses, will be less than 100 crore rupees, which mean an EBITDA of around 700 crore rupees for the company, which means an EBITDA margin of close to 33% for this company. And this deal is expected to complete by around first half of financial year 2018.
All right, Sumit, thanks for those details. Bhuma's with us as well. Bhuma, what's the bigger picture on this deal?
The bigger picture is Indian telecom operators are selling the non-core assets, get the cash in, deploy it for their 4G network expansion, which they need to do take on Jio, as well as pay a debt where they can. The twin objective here in this case is to increase the 4G footprint, take on Jio, and as well as repay debt. We just don't know how much debt they will repay, but that's the largest aim.
I remember the interview with Kumar Birla a month ago. What's the thinking within the group? From how important, how on top of priority list is this for Kumar Birla? Is he going to stay in the game for long? What's the sense that you got?
Telecom is important to the group. There's no denying it. Mr. Birla also mentioned the fact that telecom is undergoing a shakeout, where it's hard to predict the outcome. He didn't mention it will be a three-player market, three private players plus public sector company. So they will continue plowing money into it. They'll continue expanding. The whole logic of merger with Vodafone's India unit was to become a stronger player, become country's largest player. They're clearly not going anywhere. They're going to put up a tough fight.
But this may not be a related point, but this is not headed anywhere near profitability. You might get, you might get combined arms, you might get revenue market share. When are these guys going to make money?
That's the billion-dollar question. No one knows. So for now, it's just a top-line game. It's a market share game. And they hope that hopefully in the medium term, if not the near term, they will make money. In the meantime, they're trying to sell whatever they can on sidelines to plow the money back in and again put it into the main wireless business. Okay,
let's talk about the near term. Idea also reported earnings today. And it was the fourth straight quarter of losses for the telecom giant. What's dragging those numbers? Samit has been looking at those numbers in closer detail. Samit.
So on a consolidated basis compared to last quarter, it was a weak set of number for Idea, with revenues falling as much as 9% to 7,466 crore rupees in the second quarter. EBITDA fell around 20% to 1,500 crore rupees, and this is the sixth consecutive quarter where the EBITDA has fallen. Net profit also, there was a net loss of close to 1,100 crore, and this was the fourth consecutive quarter where the company has posted a net loss. Now, average revenue per user, that's the key number for a telecom service provider, came in at around 132. And it fell by around 6% compared to last quarter. Analysts were expecting the number to be around 135 rupees, but it came in below the analyst expectation, and it came to around 132 rupees. Now, three reasons why this quarter was weak. First, second quarter is said to be a seasonally weak quarter for the telecom service provider, and along with this, there were two other reasons. That is, first, the higher tax rate under GST, and second is the continued competitive intensity by Reliance Jio. Now, because of higher tax rate, the tax rate under GST was around 18%, and telecom service providers could not pass on this hike because of the continued competitive intensity that Jio brought in the second quarter also.
All right, Samit, thanks so much for that. Bhuma, thanks for joining us with perspective as well. That's the Idea Vodafone story, but we are staying with telecom for a moment. Reliance Communications' grace period to pay interest on its dollar-denominated bonds ends today, with the telecom operator already failing to honor its interest payments back home in India. All of this has taken a toll on the company's stock and bond prices. Joining us from Hong Kong, Denise Wee, to give us a sense of what the bondholders are thinking. Denise, thanks so much for joining us. The company seems to have made it fairly clear that they're not in a position to make payments right now, but are bondholders still sort of on tenterhooks a bit?
I think for bondholders, they're always hoping they would get paid, but in this case, as you mentioned, the company has said that they're in a standstill arrangement with the lenders, so the general expectation is that they won't pay, although we won't really know until, I guess, the end of today. And if they don't pay, then I guess there's plenty of stake for bondholders, because there's a big group of creditors that are surrounding Reliance Communications. They've got operational creditors like Ericsson. They're in discussions with lenders, proposing to convert debt to equity. They've also got onshore rupee bondholders. As we know, over the weekend, they mentioned they've missed payment on these rupee bonds, and they won't be making payment. That's all part of the whole, standstill arrangement. So I think there's plenty, at stake for bondholders. It should be in their interest to get organized, I think, because there's so many other players that are jostling for, a piece of Reliance. And, you've got estimates from Nomura saying that recovery prospects could be anywhere between 0 to 35 cents on the dollar. So I think, I think it'll be interesting to watch what happens next.
Denise, thank you so much for that. Meanwhile, Bill Barney, co-CEO of Reliance Communications, he's also the CEO of Global Cloud Exchange, that's the unit of Arcom. He's confident that the bond repayment issue would be sorted soon, but Global Exchange will not have any liability to the parent company. This is in conversation with Bloomberg's Haslinda Amin on the sidelines of the APEC summit in Vietnam. Listen in.
This will be the largest cable in the world, and it will connect the eastern and the western parts of India to Asia and to Western Europe. So it's for the first time, the Indians will actually have the same connectivity or essentially fiber capabilities to the rest of the world. And this is the first time in 20 years that they'll actually have this capability since the last cable that we built in 1995.
Give us a sense of where demand is coming from and what kind of demand are you anticipating?
Well, we look at this sort of in the late 90s, there was a huge boom in the internet, which happened in Silicon Valley, and then that transferred out to India and China, okay? And we're seeing that now with cloud computing. Cloud computing is moving into parts of southern China, and we think that over the next 5 to 10 years, you're going to see massive growth in that area. And so you're going to see connectivity, you're going to see what I call the cloud factories or service factories of the world will be in India, feeding out to the rest of the world through these cables.
Sounds like phenomenal growth. Give us a sense of the kind of growth you're anticipating and what that means for you in terms of profit going forward in the next 3 to 5 years.
Well, the great thing about our business is it always grows. It's just how fast. Right now, bandwidth in and out of India is growing at almost 300% per annum. Okay, so very, very fast growth. Now, prices are coming down as technology allows you to put more through the pipes, but the reality is we anticipate very, very strong growth prospects over the next 4 years. And in fact, this cable alone will triple our EBITDA when it's fully operational in 2022. We'll be 3 times the size bigger than we are today.
I want to touch on your parent company, Reliance Communications. It's missed payments.
Yes.
Do you see GCX having to continue with its dividend payment to the parent company to help out?
No. Actually, GCX has been a standalone company. It's been ring-fenced. It's a separate subsidiary. I am the CEO of both companies, but reality is that this company has operated on its own. It's had fantastic results over its last 12 quarters when it listed its bonds 3 years ago. So I don't see any challenges for that business. I do see a restructuring that will be coming through in the parent company as we exit the wireless business and we move to purely a B2B business. So there will be a change for us as a company, but we're pretty well along with our lenders, and we think that transition is in a matter of weeks away. So I think we're very excited about the next few months.
So having said that, you don't see any necessity at any point in time for GCX to borrow on behalf of the parent company to help pay debt?
Absolutely not. In fact, we're throwing out enough cash that we're actually funding this new cable from our cash flow. So we actually have got a very strong cash position. We continue to accrete cash as a company. And, good or bad, that company is a standalone. It actually cannot refund cash flow to the parent company. So it actually has to stay as a standalone entity per the bonds that we actually issued 3 years ago.
All right, Reliance Communications stock down 11% in trade today. Moving on to another stock which was under pressure in the morning. Now Larsen & Toubro trading about flat. This after the company reported a 27% jump in profit for the September quarter. That wasn't the relevant part. The concern had come about on the fact that they had reduced their order inflow growth guidance this quarter. Darshan is standing by with the sense of what brokerages are making of the overall numbers and that reduction in the order guidance. Darshan.
See, overall, if you're looking at what the brokerages are saying, most of them remain positive on L&T. Optically, they say that the numbers were good, but, there were concerns as far as, lower tax this time around, lower tax this time around, and, one of that came in. What they're saying, some of the brokerages that have come out, first of all, IDFC has come out with a report in which they've raised the target price to almost 1,259 from the earlier 1,194. What they've said is that they've raised the estimates by 11 to 7% for the next 2 years, given the fact that there is annualized increase in tariff from the Nabha power project, which is positive. They're saying that the asking rate for the second half remains steep, given the fact that the revenues have grown almost, which means that 15% revenue growth will be needed for the next half for them to maintain their guidance. But they're saying that they expect the profit and revenues to grow significantly in the second half, because that's where the strong quarters are. Edelweiss is maintaining a buy with a target price of 1350 on the the stock. They're saying that the order intake guidance was cut, but with GST issues behind, they expect that the second half will be much stronger for L&T. They're saying that they expect an EPS CAGR of almost 15% for the next 2 years, so that they are extremely positive. They're saying that the order inflow guidance was cut, but they believe that the revenue guidance will be met. But let's listen into what the management had to say to Bloomberg Quint on the order inflow being missed and their outlook going ahead.
The revision is largely as a result of reassessment that we regularly do. As things stand, we are in businesses which involve large numbers. The projects are typically big, and that's where we come out the best. And these projects have this tendency to shift between quarters depending on the decision-making processes that are involved. We did enter this year with a lot of expectation that the domestic orders across sectors, and we are straddled across sectors where investments are long overdue and required for the country's progress. We expected those to move in thick and fast. So to that extent, I think the first 6 months have gone a little away from our expectation of fast move, fast-paced ordering. The good news, of course, is none of the projects are really taken off the shelf. It's an issue of timing. We do believe that the long-term potential for these projects remain high, and we are, as an organization, interested in these opportunities. Except that in our assessment, given that we are 6-7 months down in the year and 5 months to go, the probability of all of this happening before 31st March looked a little dimmer. And we normally share our assessment with the market as and when we are in a position to make that. And that's what we have done this time. We have told them that some of the orders are being placed 2 to 3 months behind schedule. And if that were to continue, whatever that we were expecting towards February, March, could well slip into the first quarter of the following year. And hence the revision.
Shankaraman from L&T talking about his division. Let's move on now. In a bid to strengthen its capital base, Axis Bank will raise over 11,600 crore from Bain Capital and LIC, among other investors. The fundraising will dilute Axis Bank's equity by about 8.3%. Shraddha standing by to tell us what this capital raising has meant and what the street is making of it. Shraddha.
Just in terms of the numbers and how much they're raising, 11,626 crores, like you said, of which about 9,000 crores will come from the issue of equity shares at a price of 525, and another 2,500 crores will come via the issue of warrants, which will be convertible at a price of 565. More importantly, who's investing? That is the question. Bain Capital and its arms are looking to invest about 6,854 crores. Capital International will invest another 3,200 crores, and LIC, which is already an existing shareholder, they will invest about 1,600 crores. So what will that basically do to the financial ratios? This will mean a dilution of about 6.6% and 8.23%, assuming a full conversion of the warrants. And now analysts are expecting the capital adequacy ratio of the bank to go up by about 200 basis points, whereas ROE could get depressed by about 150 basis points. But broadly, what this deal does for Axis Bank is provide them with the growth capital, and also the entry of a global marquee investor will help boost confidence in the lender, especially after the disappointment with respect to the Q2 asset quality. Broadly, brokerages have given a thumbs up to this deal, with Deutsche Bank retaining a buy and hiking the target price from 575 to 620. What they have said is that they believe that this will provide a clear path for growth, even though they believe that some of the capital will be used, towards in AS provisioning. They've also said that Bain Capital will get a nominee director on the Axis board, and they see that as a positive, especially for minority shareholders. Morgan Stanley has retained an overweight and a target price of 630. They said that they had estimated the bank's capital requirement at about 14,200 crores, and now with this investment, the bulk of the capital raise at the bank is taken care of. So broadly, that's what this entire Axis Bank deal is about, and that's what brokerages are saying.
All right, Shraddha, thanks so much for that. Stock not really reacting, but I guess it had run up ahead in anticipation of that deal, 1.5% higher on Axis Bank. Staying with banking, but looking at the bigger picture, the key question, of course, remains whether the process of recognizing the stock of bad loans has been completed. Ashish Gupta of Credit Suisse believes that the gap between actual stressed assets and the amount recognized by the banking system is still about 5% of total loans. The India head of research at Credit Suisse, however, says that all of this is not unknown to the market. Hear him out.
Today, banking system NPL levels are at about 10% of loans, and we estimate there is another 5%. But this 5%, while not NPA, is not entirely unknown to the market, right? So you have restructured loans, you have SDR, you have S4A, so there are various buckets these are kept in, and of course some of the banks also give us much better indication by giving us a sense of the watch list, right? So if you put all that together, individual banks, this number is about 5 to 6% of loan, and we expect similar is the aggregate number for the system as a whole.
That's a view from Credit Suisse. Meanwhile, the country's largest general insurer, New India Assurance, debuts at a discount on the bourses today. Saloni Dhanuka is standing by with the valuations post-listing. Saloni, how does this stack against its peers?
So starting off with, it absolutely made a tepid stock market debut today, and it got listed at 748 rupees, which is a discount of over 6% as compared to its issue price of 800 rupees. Now, in terms of business, it is the largest general insurance company of India in terms of net worth, profit after tax, as well as distribution network for the year ended 2017. Now, given the listing price of 748 rupees, the market cap would be around 62,000 crore. And in terms of financials, the company has seen its gross premium book grow at a compounded annual growth rate of over 15%, while the investment income and net worth grew at 12% and 7% respectively during the same period, that is last 4 years. Now, in terms of financials, in terms of operating metrics, it has the lowest expense ratio of 20.4% as compared to its peers, whilst the claims incurred as a percentage of net premium stood around 92.2% for the year ended 2017. And do remember, the company has been yielding returns of over 15% since last 5 years, and the solvency ratio stood at 2.2 times as compared to 1.5 times according to the IRDA mandate. Now, coming to your question, that is when you compare it to its unlisted peers, it has the highest market share of 15% and highest gross domestic premium of over 19,000 crore rupees. And again, it has the highest solvency ratio of 2.2 times as compared to its unlisted peers. Now, when you compare it with listed peers, that is, its only listed peer is ICICI Lombard, considering the price to earning multiple, it is around 70 times as compared to 49 times for Lombard. And while coming to price to book value, it is around 4.9 times as compared to 8.3 times for ICICI Lombard.
All right, thanks so much for that. That's insurers. I think all of them have listed relatively, in a tepid fashion. Perhaps they're not a story which is a listing day gain story. It may be a longer term investment story, because ICICI Prudential did, after a tepid listing, see some sort of pickup. But let me move on to what we started the conversation with, GST. The council has cut rates on a number of products. The hope was that will, encourage or buoy some of these stocks, but it hasn't played out that way. Nevertheless, it does benefit them and their businesses. Agam is joining us with an analysis of which are the companies and the sectors which benefit most. Agam.
Sure. So let me start off with the biggest segment, that is the FMCG space, and HUL, gets a tick in almost a lot of these areas. So you have, detergents, or for that matter, soaps, and for that matter, deodorants as well. And that is where you see benefits seeping in hair color too, where we have seen a cut of as much as 10 percentage points to 18%. We'll have Godrej Consumer, for that matter, looking at some benefits. Moving in, staying with the FMCG space, we also have the likes of Gillette as well as Colgate-Palmolive, which would see the benefits of that cut, of course, along with HUL as well. We do have a Titan as well as Timex in the discretionary space, along with VIP Industries, or for that matter, Tainwala Chemicals. And in footwear, of course, again, we have the likes of Bata and Relaxo as well as Liberty. looking at benefits. Moving in, we are also keeping an eye on how we've seen the consumer durables play out, and where we have a lot of advantages coming in for the likes of Havells or Finolex cables for that matter. And moving to building products as well, you have a lot of sanitary ware companies such as Serra Sanitary Ware, as well as Kajaria Ceramics, or for that matter Asian Granito, looking at benefits coming in. Moving in, we also have the likes of some sugar companies along with condensed milk companies, so Nestle, Parag Milk Foods out there, EID Parry, as well as Balrampur Chini. Moving in, we also, it's not just the 28% bracket, we're also looking at some amount of advantages coming in where the 18 to 12% cut for spectacles. So Titan once again comes in here. We have a list of beneficiaries from the aviation space, so Interglobe Aviation, Jet Airways, and of course from the restaurants place. And specialty restaurants is one of the counters which is up as much as 7% today's day of trade. That also sees rates coming down from 18% to as much as 5%. So these are a whole host of beneficiaries when it comes to these GST rate cuts.
Agam, thank you for that. We're still in a short break. On the other side, we're going to be talking about the bond markets. Lakshmi Iyer of Kotak Mutual Fund will join us on the other side. You're watching Power Lunch.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back. You're watching Power Lunch. Let's take a look or a recheck at the headlines at the half hour. Equity indices weaken in afternoon trade. The GST rate cuts fail to cheer broader markets.
India's 10-year yield rises towards the 7% mark. Investors worry about fiscal slippage and tightening liquidity.
Bitcoin drops nearly 30% from record highs posted last week as users switch to rival cryptocurrencies. $38 billion in value wiped out.
Donald Trump offers to help resolve territorial disputes in the South China Sea as he enters the final leg of his 11-day Asia trip.
All right, let's do a dip into the markets to see how things are shaping up. About 0.25% lower on the Sensex on the screens. Pradeep's with us. Pradeep, what's the nature of the market and what's moving?
So if you look at the key indices, Sensex, Nifty, or even mid-cap and small-cap, in the first hour of trade, we opened higher and then slipped off, and since then we have been moving in a range. Market breadth has remained negative, I think, after the first hour of trade, and there is no change there actually. But if you look at it, with this kind of weakness, some volatility, and India VIX above 14, normally you would expect that bulls would panic, but doesn't look like. What's really happening is volatility probably has kind of inched up, and we have probably moved, I'm talking about India VIX here, from a 8 to 10, 11 range to now a range between 12 to 14, and that way probably premiums have gone up and traders are still quite comfortable with this volatility. But then also, you would say that if VIX has reached 14, there could be some reversal, which means market should find support at lower levels now, and we've been consolidating. We haven't broken the last week or last session's range, and that's why bulls are still hopeful, but activity is a lot more stock specific, so to say. If you look at the large cap, while L&T and HDFC have put some pressure, other banking stocks like Axis and SBI are actually supporting. Bob has also supported a bit. And even if you look at the mid cap and small cap, while there are some big losers due to maybe result or some other news flow, but also on the positive side, you have quite a few gainers as well. A few names, if I may mention, Hudson Agro has gone up because a big mutual fund has bought stake there, or JP Associates, the entire JP group, JP Infra, JP Power are all buzzing on some news reports that there could be several probable suitors for JP Infra stake. You also have Lux Industries, which have gone up on the news that one of the subsidiary has entered into an agreement with Virat Kohli's brand, and there are some such stocks, like Amaraja and HEG. You have DLFs and Suzlons also here, but I think if you look at the broader market, the trade is quite stock specific, and bulls are kind of trying to take some positions here and there.
Okay, thank you for that. But let's also get a voice and stick to high quality stocks with proven track record. That's a word coming in from Bank of America, Merrill Lynch, and he's giving it all its clients who are interested in buying shares in India. The international brokerage house, India equity strategist Sanjay Mukim, who was the best Sensex forecaster tracked by Bloomberg last year, believes that it's not the time to take undue risks now. Bloomberg News' Nupur Acharya, who spoke to Mukim, joins us to tell us what prompted this call. Nupur, what's the thinking at BofIML? What do they like? What don't they like?
So, if you are a savvy investor in India, you have to trade against the consensus tide, right? So, boring is the best bet, is what Sanjay Mukim is saying. Sure. And why do they say that? I'll bring it into perspective. India's P, which is one of the key indicators which market tracks, is at 22. Now, which is the steepest among the region. So, and if you compare it for the smaller companies, the measure could be very high. So, the bottom line is, please stick to safer bets, avoid risk, and deal in companies which have some consistency in delivering the performance.
What did he have to say? When you speak to investors on a daily basis, the one question that most of these guys talk about is valuations. What's his view on valuation from a standpoint of, is there a correction in the offing? Is he expecting that? Would that be healthy for the market?
So it's anybody's guess. It's like crystal ball gazing if the correction would happen. But what he feels is that the correction, if it were to come, it would not be a time correction. It could be a jolt to the market, and the risks is very broad. It can come from domestic market as liquidity keeps drying up. You have a range of IPOs coming up, and then you also have external risk. You have the slowdown in China, a US Fed rate decision. So any of them could impact the markets in India.
Specifically on newslet events of GST, bank recap, any specific thoughts?
On bank recap, he said it's a positive move in the right direction, but we still have to see the details, how exactly it pans out. So that's the word from them.
Okay. Any specific buy calls?
The bank doesn't name companies, but what Mukim was saying, that there's a very narrow portion of the market which is delivering this kind of performance, or which fits the bill for Bank of America, Merrill Lynch. So they are primarily retail-focused banks. You have auto and auto component makers and consumer companies. So they may not know they may not name the names, but the obvious favorites are Maruti Suzuki Limited, HDFC Bank, and Hindustan Unilever, who have been the best performers so far in 2017.
Last word. Fund flows. Does he expect the domestic fund flows to continue to be robust?
The fund flows would be robust, but then you have a very strong IPO pipeline, which is taking up all the whatever flows are moving to the market. So the funds, you will have a strong fund flow, but you'll also have a strong pipeline. So you will have a liquidity balance in the end.
All right, Nupur, thanks so much for that. That's the Bank of America Merrill Lynch view. Just a brief mention of the Adani Ports numbers on your screen. 2,710, I think, is the number. Harsha, you have better eyesight than me, so I'm going to request you to read those.
So 992 crore on the consolidated number, estimated at about 835. That stock was about 1% lower. The only consolidated number that we are seeing is that about revenues are about 2,710 crore. That seems marginally higher than what the street was anticipating, but that's Adani Port for you. 992 crore on the bottom line, estimate of about 835. On the top line, it's about 2,710 crore, estimate of 2,533 crore. In line with what the street was anticipating, the stock is not moving dramatically, but that's Adani Ports for you.
All right. We're going to shift focus to the bond markets and pull up the 10-year bond yield to just set up the conversation with Lakshmi Iyer, who's joining us on the phone line. That's the 10-year bond yield for you. As you can see, it's been inching higher, now flirting with the 7% mark on the 10-year yield. Lakshmi Iyer is CIO Debt and Head of Products at Kotak Mutual Fund. She's joining us on the phone line. Lakshmi, good afternoon. Sorry to have kept you on hold. First question, what has happened in between Friday and today? Is the bond market particularly nervous about GST now? I mean, more and more indications and, of course, moves from the government suggesting that there will be a perhaps shortfall on revenue.
So I think the bond markets are not so concerned about GST as they are concerned about the open market sales that the Reserve Bank has been conducting, and quite relentlessly. So on Friday there was an announcement. So apart from the auction, there was an announcement of another open market sales, which means incremental supply into the market at a time when the investor sentiment is already quite somber. So that and coupled with the fact that there is going to be the inflation data that will be released later in the day today, is keeping the market a little bit, I would say, downbeat in terms of the overall sentiments.
So, Lakshmi, if I can just come in on that. So, there's also obviously the unknown or uncertainty over what the fiscal deficit is likely to be. You're also seeing yields rising globally. Do you expect this bearish sentiment to stay here for now?
It looks like, because, and if I give an analogy to explain this point, like there are 4 Ps in marketing, I think there are 4 Cs which the bond markets have been tracking quite actively, and those 4 are basically the CPI, the crude, the current account deficit, and the currency. If I specifically talk about the CPI, as I said today, the numbers are ranging from lower end of 3.2% to higher end of 3.8%. Crude has risen almost 20% since first week of September, in say 2 months until now. Currency has been broadly behaving itself, and current account deficit is broadly okay at this point in time. But in this kind of a market scenario, what's happening is that any negative news which is being repetitively quoted is tending to have a spillover effect on the bond yields, and that's exactly what we're witnessing right now. So I would broadly believe that if today's inflation data happens or continues to be beyond the September number of 3.28%, closer to the 3.5 to 3.6, then we could see continued selling in the bond yields even at the current levels.
Okay, Lakshmi, a couple of questions. So first, on that open market operations point, so you are expecting, or the market is expecting, that because liquidity is tightening, they would pull back on OMOs, and that's not happening. That's what you were saying?
Absolutely correct. So the RBI has conducted over 1 lakh crores worth of OMO sales till date, and incrementally last 2 weeks the market has been anticipating, because of a gradual easing, or I would say lessening of the surplus liquidity conditions, the OMO sales should cease. But that does not seem to be the case. So I think conflicting motives are also leading to lack of position taking from the investor fraternity.
But Lakshmi, then the other thing you said was that the market is not too worried about GST or the fiscal side. But how is that possible? So you're saying the market has factored in a 3.5% deficit. They factored in higher borrowings may get announced perhaps in the Jan to March quarter. Or the market is believing that they'll find a way to cover up for this shortfall, if any.
So on the fiscal slippage side, right now it's a mixed bag. While some sections of the market are expecting a fiscal slippage in this financial year itself, there is another section which is expecting that even if there were to be a fiscal slippage, it may not be borrowing negative, or the additional burden of that will not come through in the market. So therefore it's a mixed bag right now. So obviously the bear sentiment prevailing, even the fiscal deficit slippage is kind of into the news currently. But as I said, even if tomorrow hypothetically there were to be a formal announcement that there is a case for fiscal slippage, my sense is that given that the overhang of the negative sentiment is so high, even that news being discounted will do no good to yields, and you will continue to see them rise. The only thing which to my mind can arrest this yield slide for the moment is a reasonably okayish CPI data, both headline as well as core inflation.
Okay, I have a slightly different question, Lakshmi. For a mutual fund investor who sort of was been riding the rally on the equity side, you're now faced with bearish undertone in the bond market side. What should one do if he's a fixed income investor, if he's a debt fund investor? What should one do?
So for starters, for any fixed income investor, long term is actually equal to 3 years if you want to have a better tax adjusted return. So we have been recommending two things. So for those investors who have already been allocated to funds such as the bond fund and gilt fund, even at this current juncture, the 2 and the 3 year returns have been fairly encouraging, at least the past 2 to 3 year return and the slightly longer term. For an incremental investor, what we are recommending is that given that the situation or the environment is highly uncertain, the tendency for aggressive rate cuts do not seem to exist. It makes sense that you have a top-up of maybe small portions of duration in your portfolio at the tail end, but incremental fresh allocations to be done to corporate bond-based strategies, or for that matter, short-term bond funds, which will help you ride through the volatility and also allow you to participate, for some potential capital gains. That's what we've been suggesting to investors. And for those who have completed 3 years, you already have a reasonable margin of safety or that cushion available. So this is not the time for you to exit at the current levels. And certainly for those who are under 3 years, we would definitely desist them from profit booking and paying higher taxes at the current juncture.
Lakshmi, thank you so much for joining us today. Lakshmi Iyer from Kotak Mutual Fund talking about bond yields, what should investors be doing. Bharat 22 exchange traded fund is all set to open for public subscription from the 15th of November. Nimesh Shah, Managing Director and CEO of ICICI Prudential AMC, tells Bloomberg Quint that the government's policies will attract more investors to the fund. He also believes that Bharat 22 offers better value than the Sensex. Listen in.
The way we have gone about creating the index, the way government focus was, government could have easily raised the money by placing it with institutional investors or foreign investors. The equity would have been lapped up. But the government was very clear that they wanted to ensure that the common man of India benefits out of this. They believe the government believes that with the rise of India and with the way India is going about and the way they are going about creating their machinery, these companies will benefit out of whatever they are doing, like the infrastructure push that they are giving or the capital investment that the government is doing. Prominent engineering companies of the government or the private sector will benefit out of it. That's what the government feels, and so that they felt that they can share, instead of giving it to the foreign investors, they can get the common man of India to invest in it. That is why the government thought of coming up with this particular index. Now, how we went about, one is that what was the intention of the government, second is how did we go about creating the index. So the companies have been selected very carefully. If you see the way the index has been created, we had a host of companies through which we had to filter and select these companies. These 22 companies we have been selected in a way that we are happy with each of the companies that we have done. I'll just give an example that ICICI Prudential itself is a prominent investor in some of these companies which are there in the index. So only after the government had prepared a checklist as to what is the price to book ratio, is it available at what is the PE ratio, what are the future potential of the company, what is the dividend yield in the company. So there was a whole set of checklists. Only if a company ticks all the check boxes, then it was getting, then it could have come into the index. So a very rigorous way of selecting the index is concerned. Government has also put in a discount of around 3% to sweeten the deal for the retail investors. And that is why the retail investors should invest in it.
Sure. I'll come to that 3% in a bit, but can you highlight what's the difference between the Bharat 22 and the previous CPSE ETF?
There are two things. In Bharat 22, first of all, we have, in addition to the government companies, we also have the private sector investment that the government had. Like 3 of the companies where government held in the shares are there in this particular index, whether it is Axis Bank, whether it is Larsen & Toubro, or whether it is ITC. So these 3 companies are there. That is different from the earlier one. Second thing is that there is a rebalancing that will be done. Suppose we have put sector limit and stock limits. So if the stock limit is 15% and the sector limit is 20%, if by March of this year, if every March we will see the portfolio, if the stock limit has gone up, then we will rebalance it and bring it down to 15%. So to a certain extent, some amount of profit booking will happen regularly in this.
Sure. And have you done any, percentage analysis of what is the correlation of the Bharat 22 with the Sensex or the Nifty?
So there is a whole comparison of 1 year, 3 year, 5 years and 10 years of Bharat 22 and Sensex. And Bharat 22 has consistently, overall this has done better than the Sensex.
All right, that's Bharat 22. Going back to the earnings of Adani Ports, Somit is standing by with the details on that. Somit, what are the numbers looking like?
Well, Adani Ports came out with an inline numbers. Revenue rose around 24% to 2,700 crores, while EBITDA rose 15% to 1,785 crore rupees in the second quarter. Margins were weaker at 66% compared to the corresponding quarter last year, where the numbers were around 71%. Now, this was because the other expenses jumped around 86% to 165 crore, while employee cost increased by 28% to 103 crore rupees in the second quarter. Net profit was also marginally down by 7% to 992 crore rupees. Now, this was because of the higher tax incidence that came in this quarter. Now, the higher tax incidence was because that Mundra port was out of the tax holiday profit, and this was in line. The analysts were expecting this to come in, and as a reason, the net profits were below. As a reason, net profit kept down by 7% in the quarter. Now, the cargo volumes for the second quarter stood at around 37 million metric tons, which was also low when compared to the first quarter, where the company handled around 50 million metric tons of cargo volumes. Container volumes, however, increased by 19%. In the first quarter, they saw a 21% increase, but in this quarter, it was around 19% increase. This was also below estimates. Analysts were expecting the container volumes to increase by around 22-25%, and it rose by only 19%. However, in the second quarter, the company's net debt stood at around 17,864 crore rupees, while net debt to EBITDA came down to around 2.64 compared to 3.3 times in the for the financial year 2017. It came down to 2.64 as of 30th September 2017.
Somit, thank you for that. Donald Trump is all set to wrap up his 11-day tour to Asia. The US president, who attended the ASEAN summit in Manila today, is currently holding bilateral talks with who he calls good friend, Prime Minister Narendra Modi. President Trump had also offered to resolve the dispute over the South China Sea, and also said there's certainly a possibility that he and Kim Jong-un can become friends. Here's Bloomberg News' Stephen Engel with a wrap of Trump's Asia tour.
The success, it depends on whom you ask, of course. If you ask Donald Trump, he says we've made great progress on opening up trade. He wants freer, fair, more reciprocal trade, of course. But if you look back at the beginning part of this trip, he has big trade deficits with those first three stops. China, of course, $360 billion. Japan, $69 billion. South Korea, $27.6 billion. So he has a long way to go. And those three countries really focus on a lot of other issues, especially Japan and South Korea, concentrating on the North Korean crisis. Now, keep in mind, you're right, Matt, when he says Donald Trump wants bilateral agreements. He thinks that's more equitable for the United States. However, in this part of the world, of course, there are two competing trade proposals, including, as you mentioned, TPP, which the United States has pulled out of, but the 11 remaining members, including Australia, Japan, and Canada, they have secured kind of a framework agreement already at APEC, so they're pushing that ball forward. They have a lot of hurdles, though. It's more than just a regular trade agreement. There's labor rights involved. There's environment protection. There's intellectual property protection. And on the other side of that, you also have another regional trade proposal from being pushed by the Chinese and the Indians called RCEP, Regional Comprehensive Economic Partnership. But there are a lot of problems there with those 16 member nations, because you're trying to get an equitable, open, free trade agreement among 16 economies that right now are not open to each other, including India. India is worried that if they open up further, China will exacerbate the already $49 billion trade deficit India has with China. India is really good in services. China dominates elsewhere. So there's still a lot of room for progress to be made.
All right, that's Trump's visit to Asia, a wrap-up of that. Before we close off the show, let's do a check on the global markets as well and see what's going to impact markets this week. Manish Singh, Chief Investment Officer at Crossbridge Capital, is joining us on the phone line from London. Manish, very good morning to you. Thanks so much for taking the time to speak with us. What's the week ahead looking like? Any major data points or earnings that you're watching for? If not, what's the driving factor?
So I would say that, what everyone is looking for is the CPI numbers, the inflation numbers both in US and Europe, because everything at this moment revolves around the monetary policy. So the expectation is that, how much of tightening we are going to see. You saw some sell-off in the bond market on Thursday and Friday. Now, of course, we've had a good run. I wouldn't call it a big sell-off. It was just a marginal sell-off. But if there's one thing everyone is looking at, it's the inflation number, because that will decide the path of the monetary policy. And it is by no means an exaggeration to say that a lot of the gains in equities have been driven by easy money policy. So any change in easy money policy is going to be something the market is going to be very focused on.
Just to take that point forward, Manish, measures of market volatility across the board are showing signs of nervousness. What do you reckon is likely to happen for the rest of the calendar year? Do you expect profit booking to take place, or do you expect this party to continue?
I would say that I am not bearish at all. I mean, I would say that if you see the GDP growth numbers that are actually getting better. Of course, we are in a late cycle in the U.S. You may say that, but if you look at the rate of GDP growth at 2.5% 2/4, that's not a big number by any means, to cause that there is any signs of recession coming down the line. What will cause the problem is going to be the rate increase, and I don't see that you will have a back-to-back rate increase anytime soon. So we might get a rate increase next month, but we are not going to get a subsequent rate increase for another maybe 2 quarters or 3 quarters, depending on how the data evolve. So I'm not bearish. I think given that the markets are at a high, you will always have any signs of a bit of sell-off. You will have some people taking profit, but then there are lots of people who haven't taken part in this rally or still expect to take part in this rally, and they join from the sideline, which is why you have not seen a sustainable sell-off in last 12 months or more than that. So I would say that, I am very constructive. I think the data, at least on the inflation side, is not going to be bad, which means that the central banks are going to take away the pedal from the easy money policy rather slowly, and that should be supportive of the market.
What does this mean for fund flows, Manish? Do you expect, capital to be deployed towards emerging markets a little more aggressively? We were talking to an investor this morning who said a large part of the game this year was about playing Korea. Do you see that changing? Will India receive a little more money?
See, I would say that India has its own story, right? So I would say that if you look at a couple of things, the bank recap story has been very positive, and that is being seen very positively by the global market. Of course, a demonetization story has been completely misunderstood or misrepresented in media as well, I should say, because the effects of that will be felt down the line in terms of, the digital banking and various aspects of tax collection. Those things are coming into play. And we are seeing a resolution on the side of GST you have seen the news over the weekend of them rationalizing the tax rate, which the impact of that will be felt. But I think for India specific, one has to look at a lot of stories domestic. I mean, you have seen a lot of money coming into the Indian equity market from domestic mutual funds. You have seen a financialization of assets, which from cash savings are going into equities, which is a good thing. So I would say that while the global picture or the global sentiment towards India is positive, it's the domestic side which is driving it. So if you have a positive fallout from GST, and despite the challenges, I think that it is a positive move, and it will start showing up in a couple of quarters, then that should be supportive of the market. So the only thing which can destabilize it is higher oil price or a strong dollar. But then you've seen that strong dollar case cannot sustain unless Fed is going to increase the rates. And oil is a very difficult one to say. I mean, we've seen oil rally almost 30% from the base of $40, and right. It's hovering around 60. Right. Yeah.
Manish, just stay with us for a minute. Harsha's bringing up a chart which is neither India nor oil nor treasuries. It's Bitcoin, Harsha.
Nor stocks.
Not stocks either.
This has to be the most fascinating story of the markets globally. This is the story of the Bitcoin in the last 1 year. Take a look at this from January. It's been a staggering 800% growth for anyone who's invested $1. That's nearly about $7,300 per bit. But three things have happened. They've had three massive, dramatic collapses in 1 year alone. A 38% fall in the value of Bitcoin in around June. And then in September, there was a massive fall, about 40%. And on Friday, there was another fall of about 29%. Why? Because the underlying technology of Bitcoin was supposed to go through an upgrade, which got cancelled. And therefore, this is the politics of this, right? The guys who are backing Bitcoin are now backing another cryptocurrency, which is an offshoot of Bitcoin called Bitcoin Cash. So on one day, when Bitcoin fell by about 29%, the offshoot went up by 20%. Now here's the real interesting part. Whether you like it or not, it's $100 billion in market cap.
Absolutely.
Even although $38 billion got wiped out on Friday, it's still $100 billion in market cap. And what might interest you the most, this started in the world as a payment system, and today is perhaps one of the most actively traded,
commodity or currency. You don't know what to call it.
I don't know what to call it in the world. Cryptocurrency for all you care. But this is taking, obviously, Wall Street is taking note. Regulators are taking note. But hell, this is where the action is.
The mainstreaming of Bitcoin. Manish, do mainstream analysts look at what's happening in the Bitcoin market? Now its futures are getting traded. So, increasingly it is getting mainstreamed.
See, I would say that futures trading is actually going to be negative for Bitcoin, because that's when you start getting the shorting. People will start shorting it. Now, I mean, I'm not a believer in Bitcoin. I do believe in the underlying technology of blockchain, but I think Bitcoin, to me, is a bubble, and I have written that in August newsletter as well. Bitcoin has no intrinsic value, according to me. I mean, it only has a price, and and things are about, people confuse between price and value. So, and if you invested in Bitcoin yesterday or day before, 7,900 or where it was, you're down 30%. You don't have 30% fall in 2 days or 48 hours. That's not a store of value. So you can speculate, and of course it could go to 20,000 for all I know. But it's not something that I would recommend to a sensible investor. If you, it's like gambling, or you're playing a roulette wheel, in a casino. So you could make money out of it. You could get lucky, but I would not call that investing.
Manish, good talking to you. Thank you so much indeed. But that would apply to many Indian companies too.
It's true. It's the Bitcoin haves and have-nots. That's the story that's played out this year. Thanks so much for watching. We're wrapping it up on lunch. Have a good afternoon.
Thank you so much.